Good afternoon, friends, clients, and family. It's been a little while since I posted a video as the markets have been extremely subdued as we continue the recovery from COVID and the 2022 bear market. However, in recent days, the volatility has increased, and I wanted to be here to share my thoughts on what is going on and what it may mean in the bigger picture. I hope your summer's coming along great. My kids are loving summer camp. And looking forward to chatting with each of you in the coming days and weeks ahead. But let's get to it. All right, so let's take a step back and look at the last 4 years as we've had a lot of government intervention post-COVID. So after COVID, COVID was a 35% drop in the March of 2020. We had a ton of government intervention, which led to a strong stock market rally in April 2020 through 2021. During the lockdowns, consumers stuck at home spent money on goods or stuff while our services economy entered a recession. But post-lockdown, we stopped spending on things and we started traveling the world and spending money on what we call services. This has led to what we call a rolling recession. The combination of government stimulus payments and low interest rates led to a boom of spending and inflation. We haven't seen inflation like this since the early 80s. To combat inflation, the Fed started raising the federal funds rate, which is short-term interest rates, to over 5% at the fastest pace in history. And this led to a 20% decline in stocks and bonds in 2022. With recession fears on everyone's mind in 2022 into 2023, the Magnificent Seven tech stocks exploded due to optimism around artificial intelligence after ChatGPT was released to the world. And finally, that takes us to today. In July of 2024, we started seeing a rotation finally, where investors started selling and taking gains in their technology stocks and started buying undervalued parts of the market, such as small cap US stocks. And this was led over optimism around Fed rate cuts due to a slowing economy. For the past year, we've been in a bad news for the economy is good news for stocks. Sort of a Goldilocks economy, not too hot, not too cold. This is because the market has been excited about the prospects of finally interest rates coming down, which would help struggling businesses and consumers. Now, last week, this all changed. The economic data was bad again. We expected a market rebound, but the market's tanked. And it's happening again today. Why? Let's dive a little bit deeper. All right. First of all, we're in a tightening cycle. The Fed has interest rates high, which makes it tough for businesses to borrow money and remain profitable. When businesses can't grow, they start laying off workers. In addition, consumers, us regular people, struggle because not only are groceries still expensive from inflation is coming down, but that just means prices of the things we buy are going up slower. They're still going up. But interest rates on mortgages and car loans and credit cards remain high, which is leading to defaults and reduced spending, which further harms businesses. Eventually, this cycle leads to a recession. But there's been optimism due to AI that businesses are entering a new era of productivity, and they can remain profitable with fewer workers. This remains to be seen because we don't know how AI will actually impact the way businesses actually work and do business. While many have been calling this a soft landing, the track record for the Fed, as seen on this chart here, of engineering a soft landing is pretty poor. Going back to the 50s, only twice have they engineered a soft landings. And to be fair, so far this period's been compared to the mid-1990s. Now, this leads us to Friday. Last Friday, unemployment data came in hot, and more people have claimed unemployment benefits. This triggered something called the SAM rule, which is named after Claudia Sam, who observed that when unemployment increases a certain amount from a bottom, a recession always occurs. And you can see this as unemployment starts increasing. We have the green lines, which means we're entering or already in a recession. Without fail, going back to the 1940s, this is always the case, and here we are today. All right, let's keep diving in. Now, if we look under the hood of this most recent report, we actually see that Hurricane Beryl, which made landfall in Texas on July 8th, led to a massive spike in jobless claims. This distorted the data. Regardless, the markets were spooked about an incoming recession, and this gave investors an opportunity to overreact and take some gains. Now, what does this have to do with the Japanese yen carry trade that we're hearing so much about today? If you haven't heard about it, if you go online, you'll see all about it. So the Japanese yen carry trade is what's causing extreme volatility, especially in Japan, but overflowing to the global economy. And over the last couple of years, many people with the threats of recession have wondered how stock prices have surged in value despite so much tightening going on in the economy. Well, during this time, Japan has had decades of low growth. And because of that, they've kept their interest rates at 0% and for a period even had negative interest rates for the past 2 decades. So sophisticated investors and hedge funds realize that instead of borrowing money here in the US for maybe 6, 7, 8, 9%, or other countries, why not go to Japan and borrow Japanese yen for essentially free? Then you can convert the Japanese yen to US dollars or another currency. And with that new money that you've borrowed for 0%, you can buy assets such as stocks, bonds, commodities, crypto. With that borrowed money, you could leverage it up, so get multiple times that amount of money, and eventually in the future sell those assets and repay the Japanese loan while the yen is weak. And currently there's a stronger currency like US dollars to the weak yen, and you could pay back that loan and make a lot of money. Well, on Friday this changed. The dynamics of the borrowing at low cost change. The Bank of Japan shocked the world and raised their interest rates to 0.25%. This surprised investors, which in turn strengthened the yen, which made the cost of their borrowed money higher. It forced a lot of investors to sell what they purchased. A lot of this was the Magnificent Seven technology stocks, and convert their dollars back to yen at less favorable exchange rates. But you might be thinking, I've never heard of this. How many people in the world could really do this kind of sophisticated trading? That's the part that's completely unknown, but some estimates are it could be as high as $20 trillion. So keep in mind the national debt here in the US is $35 trillion. That's an extraordinarily large amount of money. So what does this mean going forward? Is this a blip on the radar? Is this something we should be concerned about long term? Well, the first thing to remember is that market pullbacks are healthy and normal. A lot of the internal technicals of the market are still healthy. The rotation out of big tech has felt pretty violent, and that's because the big tech names make up a large part of the indexes we follow, such as the Dow Jones or S&P 500. But this is healthy in the long term. Remember, this chart shows you a 5% pullback happens on average once per quarter, typically 3 to 4 times a year. A 10% pullback happens on average once per year, actually every 8 to 10 months. So far, we haven't seen anything out of the normal. The market is down about 8%. In April, the market went down about 7%. So we're kind of in this middle range here, 5% every 4 times a year, 10% once a year. Nothing abnormal. So now that we have this unwind, that could last another couple days or weeks. The other thing I want you to remember is that August is historically the time everyone goes on vacation. People aren't trading, they're not buying in equities. It's typically a volatile part of the year. So seasonally, this is normal. So I see two scenarios playing out going forward. Both of them, I think, are very plausible. And we'll follow the data in the months ahead to see what's going to happen. I've been discussing these scenarios with our clients in our regular meetings. The first case is a bullish case. Could be the roaring 2020s like we had the roaring 1920s. I give this a 50% odds. And why could this be? Well, interest rates are no longer increasing. The market's looking towards rate cuts. This will stimulate our economy and should lead to a short-term rally in U.S. stocks. Unemployment is low. It's increasing, but there's still plenty of job openings. $6 trillion of cash is sitting on the sidelines across businesses, institutions, baby boomers. The boomers are wealthy with plenty of assets in stocks and home equity. And they're spending on services, enjoying their time traveling, which I encourage you to do. There's an onshoring boom due to the CHIPS Act and Infrastructure Act that's boosting domestic spending. Corporate cash flows are at record high. 80% of companies beat their earnings in the first quarter and are doing so again right now. Corporate revenues and profits are falling, but they're still positive. Inflation truly is plummeting like a rock. Housing and auto insurance were really what was keeping the inflation numbers high, and those are starting to come down. It just takes time. And as we mentioned, the technicals of the market are healthy, which is positive. A recent drop might take a few weeks to recover, but no significant damage has been done yet. And bankruptcies and foreclosures are 40% below the highs in 2008. Internal technicals of the market are healthy. This is just a chart that I look at, which we'll talk about in a moment. Let me take a quick look here. All right. So this chart essentially gives me the bigger picture of when we might want to look out for a larger drop in the market. As we talked about, 5%, 10% drops are healthy long term. If many companies begin to drop in price under the hood at the same time, typically the larger Magnificent Seven companies will hold the index up until the last moment. But a lot of these indicators will tell us and give us warning signs in advance. So I'll look at this black line. If it's falling below the gray dotted line, and especially the red line, it's telling us that a larger downturn is potentially coming. But there are other indicators that can give us warning signs ahead of time as well. They're not perfect, but they've worked in the past. One of these is called the Hindenburg omen. And this is when you get multiple, these lines right here, when they go up to the top in batches, you typically see, like we saw here in February of 2020, warned us of the COVID drop. And again in December of 2021, warning us of the bear market to come in 2022. Another indicator we can look at is something called the McClellan Summation Index. Again, this gives us warning signs well in advance when these red lines drop below the red dotted line. It typically tells us we're in for a larger correction ahead, as we saw here in 2007, giving us warning of 2008 to come. When we get back in, potentially when the green line goes above the green dotted line. It again warned us in 2015. I believe this was the Ebola outbreak. Warned us again in 2018. We had a flash 20% drop, and again in 2020 and 2022. So what's the bear case ahead? Well, recession odds remain elevated from 2023, but they are receding. The yield curve has been inverted for the longest in history. When the curve uninverts and short-term rates are now lower than long-term interest rates, recession might be nearing, and we are very close to this point. Housing struggles often lead to rising employment, and in recession, as we know, the housing market is essentially frozen right now. The Chicago PMI index, which measures economic activity, is at recession levels. Unemployment is ticking up, as we talked about the SAM rule, but also a Piper-Sandler rule. These are flash and recession signals. However, this could be a normalization from the abnormal employment figures during COVID. That's what we're trying to navigate right now. Jobless claims are going up, but they're not accelerating to a dangerous level yet. Interest as a percentage of income is increasing, and this is causing consumers to feel stressed and spend less. Retail sales are declining, and there's high valuations on certain parts of the stock market. So as we look at here, recession odds had peaked in 2023. They were near 90%, and they've since been coming down. The coincident index is telling us, where are we today? We are not in recession territory. We're still expanding as an economy, but the leading index tells us we're heading towards a recession. This has been triggered for probably 18 months now, but it can take time for this to play out. So there's some caution, there's signs of expansion, there's signs of recession. This is an uncertain economy right now. We have to follow the data. And finally, we have the Piper-Sandler recession indicator, which is telling us that if unemployment continues to rise, this could lead towards a recession. Now, as always, there's going to be risks ahead. Elections will lead to temporary uncertainty. Middle East conflict has risks of impacting energy markets, and China and Taiwan may have risks to global semiconductor production. There's always risks on the horizon, but the U.S. economy has proven time and time again to be resilient. So I always recommend focusing on what you can control. If you ever have worries, reach out to me. We can control how much we spend in our lives, how much we save. We can control how much risk we take in the market. We have some control over our health by eating healthy and working out. We have some control over our job situation, how much we educate ourselves. What we don't control is what the stock market does and the policies that come out of Washington, D.C. My job is to protect your wealth. This doesn't mean there won't be times of turbulence, but we have a close eye on the economy, the markets, and most importantly, we know you, and we know what's most important to you and what your priorities are in life. So I hope this was helpful. If you have any questions, don't hesitate to reach out, and have a great week, everyone, and great rest of your summer.